Hello and welcome back to All Things Money. I'm your host, David Blain. If you missed the first segment, we were talking about some good indicators that you can use to gauge the economy. There's just thousands and thousands of data points. I mean, we suffer from information overload, and just wanted to give you a few things that you may want to look at and some things that are not a good indicator of future GDP growth. If you missed it, I'm going to make you head on over to the website, www.dlblain.com. We'll have archived copies of the shows posted there, and you can catch up. I want to start this segment talking about a little bit more about the Federal Reserve. We've gotten a lot of questions about this, and of course last week with the Republican convention always brings up Ron Paul and this whole audit the Fed and return to the gold standard, and so there were some, albeit not forefront at the convention, but sort of these side topics are always there, and people have a lot of questions because it's very confusing, and it's basically the bedrock of our financial system is the Federal Reserve, and it's very difficult to understand sometimes. And so every so often I like to bring this topic up and see if we can't shed some light on it. And I forget, I was reading something the other day, and I came across the old drama play, Faust. Is a German play that was written in the early 1800s, maybe 1820, 1830, something like that. And it was where the premise of this drama is that the devil persuades a bankrupt emperor to print and spend vast quantities of paper money as a short-term fix for the country's fiscal problems. And without getting into all the history, if you're interested, go back and look in the late 1700s, early 1800s, what was going on in Germany, and you'll kind of get a backdrop for the drama Faust, but it's called Faust. And anyway, it just reminded me, and I'm not saying that the devil has persuaded Ben Bernanke to do this, but there's some interesting parallels here that are really uncanny. But anyway, so as a consequence, back in this drama, the empire unravels and descends into chaos. And if you have a chance to read it, it's quite interesting. So we see a number of parallels today to both what's going on in the U.S. as well as over in Europe. We see governments relying on this concept of quantitative easing, and instead of tackling the hard structural reforms, and so we see this multi-trillion-dollar easing program. Central banks around the world have really, to some extent compromised their ability to control the money supply and really making them vulnerable to runaway inflation. And because when interest rates rise, the value of the assets that these central banks hold could fall below the face value of their liabilities, potentially destabilizing their currencies. And there's a few examples here. If we look at, in the modern era, Germany, of course, in 1923, the currency, I remember reading stories, people would have wheelbarrows. They had to wheelbarrow, instead of carrying a wallet, they had a wheelbarrow to carry all the money. Of course, Argentina, 1989, runaway inflation. Russia in 1993. In Zimbabwe, back in 2007, I saw some ads recently to buy some Zimbabwe banknotes, and they were like denominations of $15 trillion banknotes or something crazy like that. But anyway, in order to understand quantitative easing, let's kind of roll the clock back a little bit and look at the history of central banking. And central banking evolved, the federal bank being a central reserve or central bank. The banks initially emerged as a place for where individuals and trading companies around the world could put their gold bullion in a central bank and received a claim that could be redeemed upon demand. And so what this did was, when these companies were traveling around the world, to India and China and starting this global trade, instead of loading their ships up with gold, of course some people would say they loaded them up where they went and looted it and brought it back. That's another topic. But instead of loading their ships up with gold to trade, they would put it in a central bank, and then their trading partners could redeem that for gold, or even just have it shifted over to their deposit account and allow them to trade. And so the central bank really, its strength derived from its simplicity. It was very simple, is that people in the British Empire, they put their gold in a bank and enabled commerce and trade to flourish. And so they could have this gold-backed British pound when they went overseas to trade, and it was a great way of doing it. Of course, today the gold standard no longer exists, and the entire monetary system is built on what they call fiat currencies that are not necessarily backed by a dollar of gold. And the reason it works is people have this abiding faith that the paper money will be accepted as a medium of exchange and remain a store of value. And so it's really based on people's confidence in the currency. And the presumption is that the central banks, the Federal Reserve, in fact, if you look on the dollar bill, it says Federal Reserve Note. Okay, it's not actually issued by the federal government. It's the Federal Reserve Note. And the presumption is that the Federal Reserve has enough assets that can be readily sold, and if the money supply needs to be reduced. And that's the presumption of currency, and it's why currencies retain their stable value. It's that confidence that central banks have enough assets that can be sold.